Hey there! Welcome to Voice of Money, where finance finds its voice. Today, we're diving deep into The Intelligent Investor by Benjamin Graham, a book that's not just a classic, but a life changer, one Warren Buffett swears by as the best investing guide ever written. First hitting shelves in 1949 and updated through the decades, it's not about flashy get-rich-quick schemes. It's about building wealth with smarts, patience, and a clear head. Over the next chunk of time, I'll break down its big ideas: investing versus speculating, the unforgettable Mr. Market, the margin of safety that saved my bacon more than once, and plenty more. I'll sprinkle in my own thoughts too, because honestly, this book's lessons hit different when you see them play out in today's crazy markets. So, grab a coffee, settle in, and let's unpack this gem together. Graham starts with a question that feels like a gut punch. Are you an investor or a speculator? It's so easy to blur that line, especially now with all the noise out there. Investing, he says, is about digging into a company's real value, its earnings, its assets, its growth potential, and buying it when the price makes sense. Picture yourself shopping for a used car. You're not just dazzled by the shiny rims. You pop the hood, check the mileage, make sure it's worth the sticker. Speculating, though, that's throwing money at something hoping it'll shoot up, like betting on red at a roulette table. I've been there, staring at Dogecoin spiking in 21, heart racing, thinking, should I jump in? Graham's voice in my head stopped me. Do you know what this is worth? Or are you just riding the hype? Look at GameStop that same year. Speculators made millions or lost their shirts in days while investors sat back, picking through the rubble for real value. Graham's rule is simple but brutal. If you can't explain why an asset's worth owning based on hard data, you're not investing. You're gambling. Then comes Mr. Market, and man, this guy's a character. Graham's brilliant way of showing us how the stock market really works. Imagine a business partner who swings by every day, offering to buy or sell your shares. One morning, he's buzzing with excitement, slapping high prices on everything. This stock's worth $100, take it. Next day, he's a wreck, dumping shares for peanuts. $50, please, just take it off my hands. His mood's all over the place, but here's the kicker. The company itself hasn't changed overnight. Its factories, its profits, its people, they're the same. Graham's point: Mr. Market's prices don't always match reality. They're just his emotions talking. Your job isn't to follow his roller coaster. It's to figure out what those shares are truly worth and act when he's off his game. When he's down in the dumps, you snatch up bargains. When he's flying high, you cash out or wait. This hits home for me every time I check crypto prices. Bitcoin at 60K one month, 30K the next. Mr. Market was losing it, but Bitcoin's tech didn't flip that fast. I've trained myself to ignore the headlines, crypto pumps, stock crashes, and ask, what's the real value here? It's not easy when your phone's buzzing with panic or euphoria, but Graham's like, stick to the fundamentals and you'll thank me later. Now let's talk margin of safety. It's the core of Graham's whole deal, and honestly, it saved me from some dumb moves. The idea's dead simple. Buy stocks way below what they're actually worth, so even if you mess up, or the market does, you're covered. Say a company's intrinsic value is $100 a share based on its earnings and assets. You don't buy at $100. You wait till it's $70 or less. That $30 gap, that's your cushion, your safety net against bad luck, bad timing, or just plain bad math. Graham calls it the central concept of investing. Without it, you're just rolling the dice. I learned this the hard way once, jumping on a hyped-up tech stock at its peak because everyone said it was the future. No margin, just FOMO. Then it crashed 40%, and I was toast. Now I'm smarter. Is this a deal, or am I overpaying? Think about 2008, banks collapsing, stocks like Citi plummeting, or the 22 tech wreck with Netflix and Friends tanking. If you'd bought with a margin of safety, you'd have slept better. Today, with markets bouncing around, crypto swings, AI stock fever, this feels like a superpower. It's not sexy, but it's how you stay in the game. Graham gets that not everyone's cut out to be a Wall Street wizard, so he breaks investors into two camps, defensive and enterprising, and lays out how each can win. The defensive investor's all about keeping it simple and safe, low risk, steady returns, no stress. Graham's recipe? Split your money 50-50 between bonds and stocks. Think high-quality blue-chip companies, or, in today's world, index funds like the S&P 500. Every year or so, rebalance, sell what's up, buy what's down, and call it a day. He even gives tips. Stick to stocks with a low price-to-earnings ratio, say under 15, and a decent dividend yield, like 2 to 3%. It's boring, sure, but it works. I've got some cash in an index fund, and it's chugging along nicely without me babysitting it. Then there's the enterprising investor, the one who's got time and grit to dig deeper. These folks hunt for undervalued stocks, poring over balance sheets, sniffing out companies the market's ignored. It's more work, hours of research, maybe some spreadsheets, but the payoff can be huge if you nail it. I flip between these myself. Lazy Sundays. I'm defensive, letting my index fund do the heavy lifting. But when I'm curious, I'll dive into a stock's numbers. Last month, I found a small company trading way below its book value, and it's already up 15%. Graham's cool with either path. He just wants you to know yourself. Most people I know, me included sometimes, think they're hotshots who'll beat the market, but stats say index funds win long-term. Food for thought. Graham's got more practical tricks up his sleeve, like how to pick stocks if you're going the enterprising route. He's got criteria. Look for companies with a price-to-earnings ratio below the market average, say 15 when the S&P's at 20. Check their debt. Keep it low, under 50% of equity. Earnings growth, steady over the last 5 years, no wild swings. Dividends, a consistent payout's a good sign. Shows they're not just blowing cash. He also loves companies trading below book value, assets minus liabilities, because you're basically buying $1 for 50 cents. Take Coca-Cola back in the day. Stable earnings, solid dividends, reasonable price. I tried this recently with a random industrial stock. Low PE, decent dividends, undervalued assets. It's no rocket, but it's up 10% in 3 months while others tanked. Graham's not guessing here. He's methodical, and that's why Buffett's obsessed with him. Long-term thinking and discipline, that's Graham's final big lesson, and it's gold. Markets are a roller coaster, up one day, down the next, sideways for months. Don't try to time it, just stay in it. Emotions like fear and greed, they're your enemies. Shut them out. Stick to facts. This resonates so much in 2025. NFTs flopping, meme coins crashing, TikTok screaming about the next moonshot. Graham's like, relax, think decades. Not days. My index fund's no thrill ride, but it's up 30% over 5 years, while my buddy's trend-chasing portfolio's flat. Patience is tough. I've stared at my phone, tempted by some hot tip, but Graham's discipline pulls me back. His famous line, "Be fearful when others are greedy, and greedy when others are fearful." Think 2008. Everyone dumping stocks in panic, but the brave who bought cheap made bank by 2012. It's contrarian, but it's how you win long term. So, that's the intelligent investor laid out. Graham's not handing you a golden ticket. He's giving you a toolbox. No investing from gambling. Tune out Mr. Market. Buy with a safety net. Pick your style, defensive or enterprising. Hunt smart stocks. And stay patient. It's practical, it's timeless, and it's why this book's still king. Now, my take. Does this hold up in 2025? You bet it does. Markets are nuts, crypto's soaring, then crashing. AI stocks like Nvidia riding hype waves, uncertainty everywhere with inflation ticking up. Mr. Markets throwing tantrums daily. Bitcoin's ups and downs, Tesla's wild swings. Graham's like, ignore the noise, check the value. Margin of safety's a lifesaver now. Tech valuations are sky high, but solid companies at a discount are your shield when the bubble pops. I've changed because of this book. I don't chase every shiny thing anymore. Long-term focus and calm vibes have made me a better investor, less frazzled. Last month, I spotted a stock everyone was trashing, did my homework, saw it was undervalued, bought in. It's up 20% already. Graham's voice is in my ear. Is it worth it or just popular? Next time you're eyeing a hot tip, try it. Dig into the numbers, not the buzz. What do you think? Does Graham's way click for you? Hit the comments below and let's keep rolling with Voice of Money. If you enjoyed this deep dive into the intelligent investor, help Voice of Money grow. Hit that subscribe button and like the video. It's the best way to support more content like this. We've got plenty more book summaries, market insights, and practical tips coming your way. If you're into leveling up your financial game, stick around. Let's learn and grow together. See you in the next one.